Good day, fellow investors. The market is right and we value investors are wrong. Last week I did this video discussing the market opportunities from a broad perspective, and there were many comments telling me how, Sven, you are wrong because value investing doesn't work. We are living in a new AI world. Stocks, US stocks only go up. And I really want to discuss this, the hardships of being a value investor, whether value investing is right or wrong now, because it's hard compared to the rest of the world's thinking about investing. But we're going to answer key questions, and the first one is, are you a value investor or not? What does it mean? How does it fit the current environment? Will value continue to be the wrong bet? That's also a possibility. Another possibility is that growth continues to grow forever. And I'll also share my value investing concept that will then give you an answer how to position yourself in the current market environment in relation to your investing goals. If you enjoyed this, smash that like button. Let's now start with the comments on this video that I made, and the context is that emerging value, according to fundamentals and let's say logic, offers positive returns in the long term, while US stocks offer negative yearly long-term real returns going forward based on, let's say, a normalization of things out there. And let's immediately start with the comments, because these comments will give a great context to where we are now when it comes to investing and the investing environment. Cookie jar, never bet against America, Warren Buffett. And that is correct, never bet against. I would never bet against and go short the market, even if the likely returns are negative. What Warren Buffett is doing is he is not betting on America, because if he has 190 billion of cash sitting in his bank account in US treasuries, giving him 5% per year, short-term US treasuries, he is not betting against, but he is not betting much on America. He is waiting for cheaper prices to buy businesses, and we'll discuss that too. Another great comment here, what do you think about TSMC, Micron, Google? If you buy that team, you could cash 100% return and then reinvest in other companies. And this comment, and there are many like these, make me think, whoa, everyone expects, oh, you make 100% here, you make 100% here, that investing is about just doubling your money like this, and then you can put it into dividends and something like that. This is a very dangerous comment, and these danger comments are all over the place lately. Further, as we discussed in that video, an Indonesian Filipinian company that has a 6% dividend yield, then with all due respect, there is a better chance of some crappy Indonesian company losing 40% than Apple or Microsoft. Now, if I look at Microsoft, if it goes back to where it was just a year and a half ago, that's a minus of 43%. Just a year and a half ago. Did the world change since a year and a half ago? I don't know. Maybe yes, maybe not. But these 1.5 year world-changing situations, I don't know. I have seen a few of them in my 22 years investing career, and it's just risky. That's all I'm saying. It might happen, it might not happen, but it's not value investing. Then continuing on emerging value has been promising to outperform since the last century. Emerging value investors are still waiting for Godot. Now, when it comes to emerging value, if we look at the emerging ETF, yes, that's totally correct. It has done nothing for the last 15 years compared to the S&P 500, up 3x or something. But that also depends. Value and investing is about the price you're paying for the reward you're getting. Those that bought here when emerging markets were unloved got a good reward. Of course, if you buy at peak exuberance, you get a bad reward. It's all about the price paid. We don't know whether we are now in a cheap environment, given the likely long-term returns, we are likely on the cheaper side that we'll discuss in a moment rather than the expensive side, given the rewards. And as Nufa says, I like the unorthodox perspective. Discussing dividends, discussing price earnings ratio, businesses, business growth is the unorthodox perspective, which is then again a dangerous sentiment in the market. And then if we go forward, commenting on Buffett's strategy that you have to invest in what you understand and what you know. That is totally correct. It's hard to go outside the US market and therefore just stick to the US market. Again, correct. But every investment, and also something that I see forgotten in the current environment in the comments, is the price paid. Everything starts and ends with the price paid. First, how much is that you pay for something? That's why, again, Warren Buffett is not doing Berkshire buybacks because Berkshire is too expensive at the current price. He prefers US treasuries rather than buybacks. And therefore, okay, yes, US, but at what price? And will that lead you to your financial goals? That is the key. So people are forgetting about price because, yeah, you buy this, it goes up 50, 100%, you make your money, then you reinvest and go on and go on. That's the sense I get from the comments. Another comment, I said the same about the big tech stocks when they were 40% lower. So there is the risk in sitting out of the rally. Okay, yes, sitting out of the rally. Microsoft is 235% over the last 5 years. I have been sitting out of that, but I'm also sitting out of the risk, and we'll discuss the risk side also in a moment. Again, on emerging value, historical bust over the years. Everyone got burned in emerging markets except for India might become an exception because of the good demographics and stability. India, alongside the US, is the most expensive market now in the world. Again, nobody thinks about price. Yes, India looks great, but you are paying 5, 10 times compared to another emerging markets that don't look as great. And keep in mind, India gives the average into the emerging markets, so there are cheaper and there are more expensive ones. I understood that China is like Italy, uninvestable. You can trade and do very good gain if you find the right period, but long term, this stock market underperformed the US. The only market to invest is the US. And Alessandro is completely right, because if we look at the money invested in the world, the whole world, this is the share of global market capitalization. 64% of the global invested money wealth now is in the United States. 64%. 12% in Europe, just 10% in emerging markets, which is 5 billion people. And then we have 6% left in Japan. Why? Because US is dominating the greatest businesses in the world. Nobody will ever change that. It's simply such an advantage that will last forever, and we cannot do anything about it. Keep in mind, the same attitude and mindset was in the late 80s in Japan, when Japan was 40% of the global market capitalization. Now it is 6%. Of course, you are now buying something that looks great, but it's better to buy when it doesn't look as great and then enjoy the ride up. When it doesn't look as great and then enjoy the ride up. When you buy peak exuberance, the risk is larger than the potential reward. And if we look at valuation, we are now price to earnings at 2 standard deviation emerging markets or the rest of the world compared to the US. So again, everyone invests in the US, everyone thinks the US is the only option, and therefore you are paying a crazy, historically expensive price. Not even to mention the dividend yield, 1.4% for the S&P 500. Again, almost 2 standard deviations above the historical comparison to emerging markets. But I can discuss whatever I want, blah 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 Sven, blah blah this, blah blah that, but the S&P 500 has proven me wrong, has kept proving me wrong, and will possibly keep proving me wrong because it's up 91% in the past 5 years. That's the only fact that we can discuss. The others are just assumptions, probabilities. But this is also a fact. The current dividend yield is 1.34% on the historical lows, and if it reverts to the mean, which is just a risk, it might happen, it might not happen, then the S&P 500 goes down 50-60%. Okay, but also earnings, S&P 500 earnings, the S&P doubled, earnings went up 20%, which means that again, just valuations went up, and valuations go up, might also go down. And this is the introduction to the first question, value investing or not? Because if you look at this, I cannot fight this. The S&P 500 is a 10x over the last 15 years. And then I'm looking at this and stocks go up, you double your money, there are some dips, but you buy the dip, you double your money, and that is the predominant psychology here. And then I look at my viewers and I see that most of them are 25, 34, 60% are around, let's say, in the 30s. And very few of these in the 30s invested 15 years ago. They were drinking beer and chasing girls here, so they maybe just started here, and therefore they have only seen markets go up. If there is a dip, the Fed buys everyone out. And Nasdaq also just going up, and if there is a dip, you make your money by buying more. But when it comes to value investing or not, I think it's just a different start of how you see investing and what leads to returns. Yes, the Nasdaq grew, but as it grew, it can also go down, as we have seen in this period. The difference between investing and everything else, just an example here, we discussed ADM 2 months ago, how it is now a value investment, and this is value investing. Look at the dividend from Archer Daniel Midland. It went up from 45 cents per share to 1.88, 4x per share in the last 13 years. The price, okay, it is now a 3x, but the business is compounding, the business is investing, the business is giving you the returns. And when you look at this and at the developing business, this is investing. You don't care what the S&P 500 does, it goes up or down or left or right or sideways or whatever. That's the first question you have to answer for yourself. Only you can do it. Am I looking at the businesses, investing in dividends, in cash flows, or I'm looking for stocks to go up, double in the next few months, I make my money and thank you, stock market. Because we don't know whether value will be the wrong bet. This hasn't done much. This has doubled in 15 years plus the dividends. Okay, you are a 3x, but the S&P 500 made a 5 or even more x. So we don't know whether value will continue to be the wrong bet. And despite the fundamentals here, the US stock market keeps going up and emerging value is stagnating, even if the businesses are improving. But both businesses are improving. However, for now, value doesn't make as much money as those investors investing in growth. Another question is, will growth continue to grow? That's very possible. I think that the Nasdaq, especially if there is some inflation, the businesses keep making money, it can double in the next, I don't know, 5 years. It can double. But then again, it can also go not as good. As many were saying, we were supposed to have a robotaxi at every corner of every street, and you just do like this and it drives you wherever you want. So the growth, the expectations, the exuberance pushes stock price higher, but no matter what Kathy blabs about across the internet and everywhere on television, when that doesn't materialize, when that doesn't happen as expected, you get this. Now, I don't have Tesla fanboys in the comments, but this is what happens, and that's also something to discuss. When growth goes wrong, it looks ugly. There are no dividends. There is not something you have to reinvest to compound. You simply kill the compounding. So that's the key risk that value investors are not taking. Another example, just recent Salesforce, just a little bit lower on guidance, boom, 21% down in a day. And now we don't know whether interest rates will go down, nobody knows. If interest rates stay higher, if the market priced that in, we are 50% down for stocks. That's the risk. But hey, crypto goes up, everyone prints money, and even Bloomberg has a crypto managing editor now. But we are here for value investing, and let me share you my value investing, let's say, idea or concept. I have no idea whether growth will keep growing and whether value investing will keep being the wrong bet. What I do and what makes me sleep calmly at night is I invest into the compounding. And no matter what happens, I look at businesses that will deliver my dividends, that will keep on growing, that keep investing in growth, so I have a good yield, 5, 6, 7%, and maybe they keep investing 5, 6, 7% into growth, into owning assets, into compounding. And then whether the Nasdaq doubles in the next 5 years or goes to half, my businesses keep on doing their business, and over my long life cycle, I just keep doing what I do, and I know that I will reach my goals. Where you are investing in other investment areas, there is just too much risk, and it's a risk that we as value investors cannot take. So the message is, keep on compounding, look for those businesses, that's what I do, research, and see what fits your portfolio, that you reach your goals with the utmost certainty. Because if you are doing the right bet, you're looking for the right bet, that's exactly that, a bet. A bet can go right and a bet can go wrong. Great example there, Berkshire in 1998 till 2000 went down 46%. And everyone would think, oh, it was completely the wrong bet back then, right? But from that period, it went up 100%, the Nasdaq went down 75%, or broke even after 13 years. So you can never know what is the right bet, but I went back to Berkshire's financial statements, and this is something beautiful. This is excerpted from 1999, total revenues 24 billion, net earnings 1.5 billion, shareholders equity 57 billion. How are we looking now? Operating earnings 37 billion. I think the equity is around 600 billion. So Warren Buffett made 20x on the net earnings. If we take average with the stocks prices 2 billion, a 15x on the earnings. Of course, the stock did a 10x since then, and that is investing. But how did he do it? By focusing on these operating earnings, by reinvesting, by compounding. That's what I want to do. I don't want to bet, I want to invest. And I know most people are here for bets, getting excited if their stock price goes up. If it goes down, they get in panic. Tesla fanboys, please comment. Tell me just in the comments how you feel, so that we, let's say, give more balance to the comments there. So this is, I think, a very important video. See how investing versus finding the right bet fits you, and let me know in the comments, how does that fit you? How do you feel? Do you feel bad about what's going on? Thanks for watching. I'll see you in the next video.